Good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the week of 7th of August. My name is Benjamin Go, the head of research and investor education here at SIAS, and I have Sunny So, my partner in crime, senior technical analyst. Today we'll be going over a couple of things, the state of the market, as well as the whole macroeconomic policy slash interest rate story. Before we get there, the most important slide is the disclaimer. So SIAS is a registered charity. We're not licensed by MES. Whatever that we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. As usual, the admin announcements. This week's RCR session is on the 16th of August in the evening. So this is exclusive to CS members. Use a QR code to chope your seat. Next one is the Google review. So do give us a 5-star review if you think we are worth it. We are definitely worth it, and we are definitely cheaper than a Burger King upsize meal. Which brings us to this. The SIAS membership is going for $1 per month, which is $12 per year, which is actually less than a Burger King upsized meal, and I can prove it. So you go to any Burger King, you're just going to look at some of the more expensive, the Angus burger and upsize, more than $12. All right, so use a QR code to join. I think one of the main benefits of signing up for for a SIAS membership is basically to join the RCS, the Monday RCS session, any questions pertaining to capital markets. Now on to today's program. The latest Bloomberg survey that was conducted the last week of July and first week of August is out, and they have analyzed the results. So they do surveys once every month or so, basically to get a sense of how Bloomberg subscribers think about certain things. So the question this time is to be or not to be. No, we're not talking about Hamlet here, but actually, what do the respondents think about the current state of the S&P 500? Obviously, it's had a good run for the last week or so until last week, when there was a little bit of a profit taking, and whether or not there's recession. All right. So if you take a look at this, about 20% of the respondents feel that or think that there's going to be a recession by the end of this year. Yes, we're talking about 2023. Yeah. So 19.8% of respondents think that there will be a recession by the end of 2023. A further 35.6% think that there will be a recession in the first half of 2024. And then you've got the 9.8% and 34%, which is further out. So, whether or not it's before or after the US presidential election. So, two takeaways here. So, firstly, is that despite what's been happening in the stock market, where people are covering their shorts, or rather until last week, people were covering their shorts as well as going along. The sentiment here, at least for the smart money professional fund managers as well traders, think that the recession has not been cancelled. So it could merely be postponed. As to whether or not it's postponed a little bit or very far into the future, that's up for debate. But professionals still think that the recession has not been cancelled. And the second takeaway is that anecdotally, what usually happens is that there could be a recession somewhere around the U.S. Election, generally after U.S. Election, because generally people, or rather voters in the U.S., think that the current president is rubbish and they want to kick the person out. And then after they vote in the next guy or the next girl, they find that the economy is not much better, and that's when it goes down the drain. Right? So that is part of behavioral finance. It's very documented. It's been around for a long time. So take that as what you will. But as you can see, the vast majority of smart money think that the recession is still on the cards. Now, the reason why the smart money think that recession has not been cancelled is simply because of the cumulative damage done to the US economy because of the last 16 months of interest rate hikes. So now the current Fed funds rate is about 5.25%, and there is a more than even money probability that they're going to hike it for another 25 basis points in the September um, Fed funds, or rather the FOMC meeting. All right. Now, this is what the professionals think, and this is despite the current resilience in the U.S. economy. So you have got the jobless rate, you've got the non-farm payroll, so on and so forth. You've got the resilience in the average hourly wages. All that's still holding up, but despite all of that, the respondents think that it's because of the high interest rates that will bring down the economy. And this is also despite the Fed's own economists thinking, or rather changing their forecast to say that they don't think that there's going to be a recession anytime soon. Okay, now, what is the street thinking? Well, you can actually look at the Fed funds futures prices. Okay, these are actually contracts traded on the Chicago Mercantile Exchange, and you can actually work backwards to calculate the implied interest rates. So when we take a look at that, this is what we get. So the implied interest rates, if you're talking about 6 months, 12 months, 18 months out, if you look at the blue color line, it does suggest that the professional community do think the interest rates will be dropping starting in 2024 from the current 5.25%. So the great question is, of course, why would the Fed want to cut interest rates in 2024? And of course, the classic answer is that the Fed will cut interest rates simply because there is a recession. Okay, so if you look at the Fed funds prices as well as implied interest rates, we get a window into some kind of forecast by the smart money into 2024. Smart money thinks that the interest rates will drop, and of course, the classic reason why that happens is because there's a recession. Okay, so this is in line with the survey results. The current pricing in the futures markets is in line with current survey results. And of course, what's the next step? The next step is that when interest rate drops, how do you position yourself to make money? The classic playbook is, of course, to go long on the long duration bonds. That means AAA rated. Okay, sorry. So U.S. sovereign has just been downgraded by Fitch to AA plus. Okay, so you want to go along with the government bonds, but you want to buy up the long duration bonds, and that's defined as more than 7 years. All right, so don't buy the bond which is a 1 year maturity. That's the money market instruments, or the 3 or the 5, but do the 7, 10, and if you're really sure about your convictions, then do the 30 years. Buy the 30 years. And the whole reason for that is because long duration bonds tend to increase in prices much more compared to short duration bonds when interest rate drops. Okay, so we're not going to talk about the whole duration calculation thing. You can go and look up your CFA curriculum or textbook. But the whole point is that bond prices and bond yields are inversely related. So if the traders are buying up the long duration bonds, that means demand goes up, that means price goes up, right? So if price goes up, that means bond yields will drop. So that's why you can see over here on the right-hand side of the chart, the bond yields, or rather the yields for the long duration bonds, especially the 10 onwards, is actually much lower compared to the yields for the shorter duration bonds. So obviously, this is an inverted yield curve. So we've hit this point some time back. But again, it is in line with the survey results. Okay, moving on. Now, so let's take a peek at the survey results with regards to the US stock market at the current point in time. Again, bear in mind that this survey was run at the end of July to early August for about 10 days. And the respondents actually put down, or rather 47% of the respondents actually expressed a view that a bubble was created simply because of irrational exuberance. Very specifically, it was driven by the whole AI hype that drove Nvidia, Microsoft, and to lesser extent AMD, the prices so high year to date 2023. Okay, so that is actually the polarity, not majority, but the vast majority, most of the people, so 47%. All right, so you have a quarter saying that this is a bear market rally, so it's actually a trap. And you have got the most bullish case, 28% of respondents think that the bull market has room to run a little bit more. Okay. Now, our take, at least from a valuation perspective, obviously, is that for the stock market to grind up further, earnings need to improve. Right. The whole reason is because the S&P 500 PE ratio right now is relatively high. It stands at 21.8. That's relatively high. So it used to be around, on the average, if you look at the 20-year average, minus off the COVID period when earnings were really poor and therefore PE ratios were really high. So if you take out that period, right? So the PE ratio on average is about 16 to 17 times. Well, 16 to 18 times. So right now we stand at 21.8, which is pretty high. Okay, so in order to support the PE ratio or rather support the price of stock markets, the earnings will need to improve, and therefore PE ratio must be able to stabilize at a relatively lower level. Okay, so the E needs to go up, so earnings need to improve. Now, is that actually happening? Well, we are coming to the tail end of the second quarter earnings season in the US. Out of the 498 component stocks of the S&P 500, 422 have already reported. If you look at the, and let me see, can I annotate here? If you look at this part over here, you have got a sales surprise. Sales is obviously revenue. Is there any kind of surprise, upside, downside? And then you've got a profit or earning surprise, upside, downside. If you look at the sales revenue side of things, on aggregate, the sales surprise is a positive 2.12%. And the earning surprise is quite a solid 7.62%. So meaning the revenue and profit beat the consensus estimates by this respective ratio. So it sounds, quite good. So if you look at the sectors wise, the only two sectors which kind of did not meet expectations was materials as well as utilities. That said, all sectors actually meet their consensus estimates. If you look at consumer discretionary, that's quite a very nice, healthy 25% beat. All right. So consumer discretionary is a sector which includes products which you don't really need. For example, your $80 Crocs sandals. Yeah, or your bling bling Louis Vuitton bag, so on and so forth. Okay, so it sounds very rosy. Well, the bad news obviously is that the consensus estimates were lowered quite a fair bit. That means the bar is actually quite low. And how do we know that? Well, we can look at the sales growth as well as the earnings growth. The sales growth is almost flat. Well, okay, so let's be a little bit charitable. It's 0.58%. Yeah, that means this is not versus consensus, this is versus last quarter. So that means the Q2 versus Q1 revenue growth was a paltry 0.58%. The earnings growth, that means Q2 versus Q1, was negative 7.76. So as you can see, right, the consensus estimates were lowered so low, and hence it was so easy to beat them. Okay, so that has fortunately or unfortunately, this is actually sticking to our view since the beginning of the year actually. So we said that the second half is going to be better, and obviously, as you can see, right, the earnings decline is narrowing, right, but it's still not back to recovery yet. We do have got data points coming in that also support that support the view that in Q3, Q4 earnings, we're gonna see a further narrowing of the decline. Q4 possibly a zero decline or a small growth, and therefore in 2024, then we're gonna have what you call a positive growth. All right, so this is still sticking to our view since January. So yes, we did brush up and clean up our crystal ball, and since we're working right now. Okay, so with that, I'm gonna leave Sunny to talk about the charts and where we should go in or not.
Yes, thank you, Ben. So I love your last line. It's not great, but it should get better. I think that's a very very good line of description that says where we are now in the market. So let me just share my screen here first. So I'm going to share with you the economic calendar first. So last week we have the non-farm payroll data. The July number comes in at 187, which was about 2K higher than the previous month reading, but was much lower than the 200 days consensus or market estimate. Headline numbers, unemployment rate for July comes in at 3.5%, 0.1% lower than the previous month reading, and also 0.1% lower than the market consensus as well. So this headline number seems to be pretty okay and not the kind of numbers that will push the Fed to increase or have another rate hike again in September. However, I would say that this data is a kind of mixed bag of data. Although the headline numbers, the non-farm payroll numbers, as well as the unemployment rate looks pretty okay, below the market consensus, but slightly above the previous month reading. But then the average hourly earnings or the average hourly wages was actually 0.1 or coming at 0.4, which is 0.1% higher than the previous month reading. So that might be a bit of a concern. So I think the non-farm payroll data or the jobs data that came out last Friday was actually a mixed bag data. So not really telling us or giving any indication or sway to the Fed decision in September or whether what they will do next. So it's a mixed bag of data to me. So I'll be looking at other indicators to see how will the Fed decide in September, and that will come in on this Thursday inflation rate data. Okay. So the US is set to release the July inflation number on Thursday, 10th of August, which will show whether the price pressure are trending down and if the markets are correct in believing that the Fed is close to ending its aggressive cycle of the interest rate hike. So if the numbers are lower, it will make it more likely that policy makers will be holding off raising their interest rate at the upcoming September meeting after the quarter percentage point hike that we saw last month. So we expect the inflation rate month on month for July to come in at 0.2% in line with the previous month numbers. Year-on-year numbers will come in at 3.3%, which is 0.3% higher at the compared to the previous reading of 3%, so 0.3% higher. So we want this number to be lower so that Fed will not hike the interest rate again. So core inflation rate number for core inflation rate month-on-month data, consensus is coming in at 0.2% for now. It may change later towards as we get closer to 10 August. But generally, it's very close to the previous month reading, and the core inflation rate year-on-year numbers is expected to come in just a tad lower at 4.7 compared to the 4.8% reading the previous time. So the data that comes in, the inflation numbers, will really be driving the market for this week. So talking about earnings earlier on, which Ben covered pretty in-depth, I would just want to scroll through. If you look at the earnings calendar for this season, you can see that most of them, the EPS are all in the green, so which is in line with what Benjamin said just now. So for some general calculations, 422 companies have reported out of the S&P 500, 498 companies. That's about 84%, 85% of the companies have reported, and I believe based on the research that I'm reading, more than 80% have beat their earnings per share, kind of a consensus or market estimate. So this is a very good number, which is why just now I said the last line that Ben mentioned is not great, but it's getting better. So this is definitely, this earnings season at least is driving the markets higher, as we can see from some of the major index. Okay, so this week, Monday, August the 7th, we will see Palantir Technologies reporting their earnings. So a very kind of a popular counter with the traders where a lot of people trade into it. So it's also a very volatile counter. So do look out for that. This might drive the market higher or lower. And of course, on Wednesday, August the 9th, which is our National Day, Walt Disney will also be announcing their results as well. So this will, everyone will be watching towards the numbers of the Disney Plus subscriber, and then they will compare to Netflix and see how Walt Disney has performed. And next week we have Home Depot will be reporting their earnings, so that will give a more general overview of how the market is doing or how the retail spending is going to do going forward. Okay, and any positive guidance coming from the companies as well. So before I go to the charts, let us go through the Fed Watch tool, which is calculated based on the Fed Fund futures pricing, which Ben also touched on earlier. So the latest reading I have was that we are likely going to see a probability of 86.5% of a sort of a no hike in the September 20th meeting. So 86.5% of the probability now says that there will be no rate hike in September meeting. And then compared to the 13.5% that says that we'll see another 25 basis point hike to bring the interest rate to 85.75. So this is the current probability now. It may change after the inflation numbers comes out, depending on which way the inflation numbers come out to be. So, but I think a majority of the market is now pricing in, at least the major index are saying that there should be no interest rate hike, or we have already reached peak interest rate now since the previous month rate hike that we saw. So which is also why I will go to the charts now. We see that market is already at the peak now, and we have seen like more than 5 months of gains throughout the 3 major US indices. So let me go through the Dow Jones Index first. So Dow Jones Index in the past week, have reached a peak over here. You can see the candlestick start to plateau over here around the 35,490 points level. Why is it so? Because this level was actually, if you dive back 12 months ago, this was the August or the April, more than 12 months ago. Last year. This was the previous high that we saw in April, and that was the resistance level that we are testing now. So this 35,492 is the resistance that we see, and then the 20 days moving average, which is the basis of the Bollinger Band, giving some support to the Dow Jones Index. So where will the Dow Jones Index go? I would say this week largely depend on the inflation numbers. If the inflation number comes in lower, it will be another boost to the index or the stock market as well. So that means we will be able to push above this 35,490 or 35,500 if I round it off. And then this level will become the next support level for the Dow Jones Index to push up further towards the end of the year as we reach the terminal interest rate. However, if inflation were to blow up again and then the numbers come in higher than expectation, higher than the previous month reading, then the lower bound or the next support will come in, as you can see, will be on this uptrend line, connecting the low of October and March, which was tested somewhere in May and then still proved to be holding on to this uptrend line in green. This will be the support level for the Dow Jones Index, which will come around the lower bound of the Bollinger Band at 33,800 points, or to round it out, 34,000 will be the support for the Dow Jones Index, which I'm looking closely. If it will come down to 34,000, then definitely I would have deployed more cash in my portfolio into the Dow Jones Index components. So next, let's move to the S&P 500. S&P 500 broke below the 20 days moving average. So that is the sign that it's a sign of a reversal, and we may be going into a short-term reversal or a pullback. So where's the next support for the S&P 500? Definitely, I have an uptrend line here connecting the low of March as well as the May period. So this is the short-term uptrend line, okay, which is based on the data of this year, the first half of this year. So this uptrend line now coincides with the lower bound of the Bollinger Band, 4,408 points. So this is where I'm looking to get back into the S&P 500 index. Of course, we can see that this double top formation here, which is a resistance level, may also become a support level. But looking at the indicators right now, you can see that MACD is very much deep into the negative territory, and the RSI has broke below the 50-point neutral mark. So thereby, I think that this double top that you see would not have actually a change in polarity and becomes a support level. I think a better support level would at least come in the first level of the lower bound of the Bollinger Band, which is at around 4,400, with the next support level around this level, which is the high in August at 4,325 points. So I'll cover the Nasdaq Composite Index before I move to the STI. So Nasdaq Composite has also moved below the 20 days moving average, now using this double top, which you see in the month of June as a support for now, but also kept under the 20 days moving average. So that's not a very good sign. That's actually a very bad sign. If the candlesticks were to trend below the 20 days moving average, it means that it's a bear market. Okay, on the short-term support uptrend, you can see connecting the low of March as well as the low of May. We have a short-term uptrend line that is around the lower bound Bollinger Band at 13,600, and just lower that, there's another uptrend line connecting the low of December and March this year, which will come in around the 12,500 level. If a major pullback is supposed to happen, that means we have very bad kind of inflation data coming in. We might even pull back to this level. So if you look at the indicators, MACD indicators, definitely very negative in the rate right now. The RSI has also just crossed below the 50-point neutral mark. Thereby, there's still a lot of negative momentum in the S&P 500 as well as the Nasdaq Composite Index. So the first level of support to get back into the Nasdaq Composite Index would definitely be the lower bound of the Bollinger Band before we assess the situation further and see how the indicators are reading the movement right now in the Nasdaq Composite Index. Okay, lastly, I'll move to the STI index. So STI index, we have a pretty nice rally since the beginning of July, or for the month of July. You can see that a lot of gap up over here. So that is also a sign that this rally is not sustainable. So gaps are some signs that telling us that the rally might not be sustainable and then a pullback might really happen. So this rally that we see in July tried to retest the year-to-date high, which happened around the beginning part of the year over here in January at around the 3,400 level, 3,408 points level. We are unable to test that level, and then the market lose steam somewhere towards the end of July, and then in August, we start to see a pullback. Now, we can see a bit of bounce today, which is not surprising because we are near to the 20 days moving average, which will provide some kind of a short-term support for the Straits Times index. However, I think if today we are unable to cross above this level, which is the April high, and use it as a support, then that means that we might have to have a little bit more of a pullback, which is maybe in line with what the indicators are telling us, because the MACD has just crossed below the signal line, and that would be seen as the beginning stage of a pullback, and the RSI is still holding up on the above the 50-point neutral mark. And if it is able to stay above the 50-point neutral mark and then stay above the April high of about 3,300 points, then that means that this rally that we see in July may continue and retest the January high. However, if the RSI broke below the 50-point neutral mark and the MACD continue to deteriorate further, and we are unable to close above the April, somewhere around the April high of 3,300, then maybe the downtrend will continue to this point over here, which you can see is the green support line, uptrend support line connecting the low of October as well as March this year, which will provide a firmer footing for the SCI index to trend upwards on this uptrend line. So that is my take of the US indices as well as the STI index. A lot of data to look forward to this week. Anything else to add, Benjamin?
Thank you very much for that. So always very illuminating. So looks like, yeah, so we need to give it a few more days of data point to decide whether to go long or short or just to do nothing and watch Netflix.
Yes, at least until the end of this week, at least until the inflation data that comes out on Thursday, then we have much more clarity on what we should do. But I'm expecting the pullback to sustain a bit longer, at least towards the end of the week, before I consider starting to take any actions to go long in the capital markets.
Okay. So one point to note for viewers out there is that the development in the Ukraine crisis may have an impact on inflation, simply because now they're shooting at each other's tankers as well as ships. So already the wheat prices are jumping up, and in the last few days, Ukraine has targeted Russian oil tankers, so on and so forth. So as you can see, right, commodity prices will react quite quickly with respect to obviously kinetic attacks on civilian ships. And already this week we're gonna have a ballooning insurance costs for Russian shippers. All right, so that at some point may feed into inflation, but it may not show up in the upcoming data points simply because of the lagging effect. So we shall see, lah. All right, so thank you very much for joining us today. More of a, I guess, meaty video today, simply because of what's been happening in the market. So I want to thank Sunny, and you guys have a great week ahead.